Hello and welcome to this webinar for the World Energy Investment 2020. We're delighted to see so many of you joining us today. The World Energy Investment Report was released on the 27th of May. We're very pleased to see the resonance, the discussion that it's generated. Certainly if we look at the traffic to our website, we see that it's more than doubled since the compared with the World Energy Investment Report from last year. So we're looking forward to a great discussion today. My name is Tim Gould. I am the head of the Energy Supply Outlooks and Investment Division here at the IEA. And I'm joined here in the office at a suitable distance by my colleague Michael Waldron, who is the lead of our investment team. And you're going to be hearing from him shortly, presenting the key findings of the report. Then we're going to move into a discussion session when we will be moderated by our chief economist, Laszlo Varro, who's also here, and remotely joined by two more colleagues, Lucilla Arbolea, who is the lead on the power sector analysis, and Simon Bennett, who was the lead on the efficiency end use analysis and also on research and development and innovation. We'll probably spend 20 minutes or so on the presentation and then we'll move to the discussion. And we also look forward very much to hearing from you. You have in the browser the opportunity to send us your questions and we'll get through as many of those as we can. We'll take those anonymously. So please let us know what your reactions are to the findings and the areas that you'd like us to explore. In a normal year for the World Energy Investment, we'd be looking back at last year, so we'd be talking about all the interesting trends from 2019. However, as we're all aware, this is no ordinary year. So the investment team has been really switching its focus to what's happening in 2020, the way that the pandemic is reshaping capital flows into the energy sector. And in order for us to do that, we've accumulated all of the latest data from industry, from governments, on investment projects, on some of the events, the developments that we're seeing this year. We've also had an extensive round of interviews with leading industry experts and commentators. But we haven't just looked at the period up until today. We've also taken a view on what that means for 2020 investment as a whole. And those estimates, which Michael will present in a minute, obviously based on assumptions about the duration of the lockdowns and so on, and the shape of the eventual recovery. So without further ado, I would like to pass the floor across to Mike to introduce some of the key findings. Thank you very much.
Thank you, Tim, and thank you everybody for joining us this afternoon or this morning or this evening, depending on where you're listening from. So yes, just getting straight into the results of what we see for energy investment in 2020. Initially, when we surveyed, we analyzed all the company spending plans. We thought that investment might rise by about 2% in 2020. Now, 2% does not seem like a lot. But considering that energy investment on a global basis had been declining steadily since 2014, actually the 2% growth that we expected in 2020 would have resulted in a somewhat break in trend or a somewhat positive development for energy investment. Instead, with the COVID-19 pandemic and the global changes that we've seen in the global economy, this 2% increase has turned into a 20% decline in investment. A record decline of almost $400 billion, with most regions, almost all regions of the world affected, but particularly those regions whose industry, whose energy sector is dependent on oil and gas. So countries like the United States and regions like the Middle East and Russia and the Caspian. Of course, cuts are occurring in all parts of the world and across all the different energy sectors, and we'll go into the details in some of the subsequent slides. So what is driving some of the cuts in investment? And when we're talking about investment, we're really talking about capital expenditures being made by companies, being made by households, being made by governments in some cases. So the first cut that we've seen, or the first reason we see for cutting investment, it has to do with some of the practical considerations, some of the restrictions on labor, the movement of labor, equipment, deliveries, project development that have been associated with the crisis and the economic fallout. But it's also the results of economic impacts. So balance sheets for a number of energy companies and a number of consumers are weakened. There's uncertainty over demand. There's lower prices for energy. All these signals seem to suggest that companies should be spending less on investment. And indeed, this is borne out when we're looking at the implications for revenues for the different energy companies. So about 90% of revenues, and these are revenues spent by consumers on energy, which goes to energy companies, but also to governments. About 90% is typically spent on oil and electricity, with a smaller role for other fuels. What we've seen is, in particular in the oil sector, the reduced demand and prices has resulted in a fall off of about $1 trillion of lost revenues that we expect in 2020. But it's also resulted in somewhat of a downtick in the electricity sector, where not only do they face demand and pricing issues, but sometimes issues related to non-payment or delayed payment of electricity bills. Electricity revenues are usually quite stable over time, so the downtick we see in 2020 is quite stark. The implication is that for the first time ever, we would assess that consumers would be spending more on electricity than they would on oil, at least in 2020. And this has implications for all the companies involved, as well as the governments who receive taxes and revenues that are based on these energy revenues. Now, looking at the different sectoral implications for energy investment, it should come as no surprise that the largest cuts in capital expenditure we see are in the oil and gas sector. Investment cuts on the order of about 1/3 in 2020. Power declines by about 10%, which I'll talk about in more detail in a few slides. But we also see quite stark falls in things like coal mining, coal supply, and also energy end use inefficiency, which is very much tied to reduced economic activity in terms of automobile sales, construction activity, and industrial output. Now, the next two slides are going to focus in particular on those oil and gas numbers. So what's really driving these? So you can see from this slide shows you the initial expectations for capital expenditures in 2020, where companies see capital expenditures now, and the delta between those, so the reduction, affecting all types of oil companies. So majors, national oil companies, independents, and other integrated oil companies, with investment cuts on the order of some 20 to 30%. But there's particular segments that are hit very hard. One of those segments that is hit hard is the US shale industry. It's a set of companies who are smaller, highly leveraged, who were struggling to generate positive free cash flow at $50 per barrel. And at today's oil price levels, generating positive free cash flow becomes even more difficult. This is a sector where has depended heavily on access to short-term finance, short-term debt markets. And here, with risk appetite being repriced across the financial markets, these companies face somewhat of a credit crunch, as well as reduced profitability. Other companies, such as national oil companies and also the service companies, are highly affected by what's going on. And the big difference between now and 5 years ago, when we had a downturn on oil prices, during the previous downturn, oil and gas companies had pretty good scope in order to cut costs. But now, with a bout of cost cutting already taken place, there's reduced scope to cut costs. And many of the CapEx declines are feeding into reduced activity, rather than companies being able to just tighten their belts. Now, what would be the implications of these cuts in terms of physical oil supply? When we're looking at 1 year of reduced investment on the order of what we see in 2020, this could result in about a loss of 2 million barrels a day in production in 2025. The cuts in investment don't feed immediately into production, but the implications play themselves out over several years. Now, the warning, or the perhaps danger sign, is if investment stays at low levels, we could lose, or the world could lose, up to some 9 million barrels a day by 2025. This is on the assumption that investment cuts stay over the medium term, over the next 5 years. The loss of production could raise some warning flags for perhaps tighter markets or price volatility if demand rebounds to levels that it was in the pre-crisis trajectory. Now, turning to the power sector, we see the changes in 2020 investments are much less dramatic. So I said it's only a 10% drop. This is about $80 billion. But the power sector is very much at the heart of different strategies for economic development and for energy transition around the world. So falling investment levels is a warning sign for both of those trends. Now, what we did is we did a comparison between, in this slide, between 2015 and 2020. And the chart on the right shows you the cumulative change since 2015, because the decline in power investment in 2020 is actually coming on the back of several years of declines, in particular in several technologies. This is most obvious when you're looking at the decline in coal power investment we've seen the past 5 years, which is the sort of brownish piece in the column chart on the right. But we've also seen lower investment in other flexible power, such as gas power. Two big things kind of stand out from the 2020 decline. One is the decline in electricity network spending. So this goes down by only about 9%. So it's relatively resilient compared to the rest of the power sector. But when you're looking at the cumulative effect of declines in network spending that we've seen over the past few years, it means the world is spending a lot less on electricity grids than it was 5 years ago. And this raises some concerns for the transition of the power system to a more sustainable mix with higher degrees of variable renewables. And it also raises concerns about the ability of power systems to be resilient and reliable enough to meet energy security needs. So this is a theme that we'll come back to probably in the Q&A. The other big thing that stands out in the power sector investment is also the decline in renewables. Renewables decline by around 10% in terms of capital expenditures. Again, renewables are relatively resilient compared to some other places of the energy system, particularly fuel supply. But this decline of 10%, even as renewable costs still also continue to decline somewhat, is coming at a time when investment in renewables would really need to ratchet up to meet long-term sustainability goals. So over the next decade, investment in renewables would need to double. And now we're seeing it going on a declining path. Now, looking at some of the underlying stories going on in the power sector, we've highlighted some of the, let's say, some of the warning signs and as far as scaling up technologies which are needed for a sustainable power system. And one area that we've looked at constantly, or we've tracked for several years now in the investment report, is final investment decisions for coal power. And so this is showing you the gigawatts of the approvals made for new coal power plants over time. These have come down by quite a bit, by 80% since 2015, reflective of a number of factors related to overcapacity in some countries, but also reduced financing options for new coal power plants. But what we see in 2020 is that approvals and sanctionings have witnessed a bit of an uplift, or a bit of an uptick. So at an annualized rate, they're running at about twice the rate seen in 2019, based on the approvals announced in 2020. Many of these were in China, but they were also in other countries in Asia, Southeast Asia, South Asia, and other places around the world. And this is coming on the backdrop that at the same time that coal FIDs continue to decline, the coal power fleet overall continues to expand. So the gigawatts being added to the coal power fleet still is in positive territory, despite the reduced growth that we've seen over time. Now, when we're looking at the different set of technologies that compose kind of the clean energy universe together, and we're looking at the spending on these technologies, this also provides an important indication as to the state of the global energy system and its progress in terms of energy transition. And last year, one of the messages from our World Energy Investment 2019 was that spending on clean energy investment had remained relatively stable over time, so it wasn't growing, even as costs were coming down in some key technologies such as solar PV and electric vehicles. And also that clean energy investment was stuck at about 1/3 of total energy investment. And this ratio needed to go from 1/3 to 2/3. Now, what we saw in 2020 is the ratio, so the share of clean energy investment actually went up by quite a bit, or we expect it to go up by quite a bit, to near 40%. That said, the reason why the ratio is going up is very much due to the weakness and the fall off in fossil fuel related investments rather than to any renewed strength in clean energy investments. While clean energy investment has been relatively resilient compared to the fuel sector, it's still declining in 2020 and is below this kind of 600 billion average that we've seen over the past 5 years. So definitely not a sign of strength that we're seeing coming from the sector to meet longer term sustainability goals. Now, when we're looking at some of the, in the second half of the presentation, or the last few slides, we're going to touch upon some of the stories that we raise in the financing section of the World Energy Investment, also the research and development and innovation section, looking at some of the ways or some of the pathways to kind of get through the crisis, and in particular, how investments in certain technologies may be scaled up. So the financial situation right now is that we see many energy companies with significantly weaker balance sheets, rising cost of capital for a number of actors in the energy system, corporates who are outside the energy sector who sometimes serve as important off-takers, delaying that power purchase agreement they had planned for renewables, or limiting their research and development perhaps on new technologies. The funding situation is also the case where an entrepreneur or a startup may find more difficult capital markets or more difficult access to capital to be able to launch that new idea or to find venture capital. And then the impact economically on small and medium-sized enterprises and households means that many smaller actors or many consumers may think twice about replacing that old inefficient boiler or installing a distributed PV system on their home. So all of these sort of background conditions of what's going on in terms of economics raise challenges, in particular for newer and cleaner energy technologies. So one thing we did is we examined some of the financial, let's say, pathways or some of the financial implications from all this. What we see is that first, when we're looking at the capital markets, there is some evidence that clean energy has made more financial sense for investors during fossil fuels, particularly during the crisis. This is what the chart here shows. It shows a performance of an equity portfolio, the total returns since the beginning of January this year, where the renewable power portfolio has significantly outperformed that of the fossil fuel supply portfolio. But this is also a trend that we've seen over the past 5 years. And in some joint work that we did with Imperial College, we've looked at the returns and the volatility of these different segments, and have found that even over the past 5 years, renewables equities that offer investors a higher rate of return with lower volatility. That said, these conditions alone don't necessarily mean that a massive capital allocation among investors can occur, because there's also challenges related to the scale and the liquidity of a number of these investments on the renewable side. Now, another financial issue that we looked at in the report relates to the actors who are doing the investment. So the actors who are actually making the capital expenditures and those who own the projects. And here is where the role of governments comes in quite starkly. We looked at the ownership of different energy investments by type of owner, so whether it was a state-owned enterprise or national oil company, or whether it was a private company, and we saw that there's quite big differences across the energy sector and across geographies. Globally, SOEs account for over 35% of energy investments. This is a ratio that's gone down over time, but in emerging economies, they play a particularly large role, with nearly 60% of energy investments being made by state-owned enterprises, and in particular in sectors related to infrastructure and also fossil fuels. Globally, it seems that renewables, efficiency, cleaner energy technologies, those types of investments are made more by private actors, but those private actors also depend on the signals, the policy signals and the incentives offered by governments to make investments. And in advanced economies in general, there's more financing options, as illustrated by the low participation of state-owned enterprises, but also illustrated by some analysis we've done looking at the role of institutional investors in energy investment. So this slide is looking at the refinancing and acquisitions by institutional investors. This is something which has gone up over time. It's looking at large-scale energy supply projects, whereas things like securitization would be more representative of what's going on in the refinancing of small-scale assets, which is not included here. But a couple messages here is that institutional investors have become more active in helping to refinance, in particular renewables, but also infrastructure projects with perceived reliable cash flows, and that they're playing an important role, particularly in advanced economies. But their potential has not been reached in the emerging economies in terms of providing new capital. And so finally, when we're also looking at areas or pathways to shift investments, Research and development is also a very important part of this. We have a chapter on research and development and energy innovation. And what we've seen in the past few years is that government R&D, so public sector R&D, has been going up, which is a good news story, and that the vast majority of this, some 80%, is devoted to low carbon technologies. But nevertheless, there are uncertainties and risks about the trajectory of R&D, particularly in the current economic circumstances. And the ability of R&D to be included in recovery measures will have a big bearing on how these budgets play out in the next few years. So with that, turn to the conclusions, which I won't go through the conclusions, but I will leave them up there as food for thought. And I will turn the floor back over to Tim to start the Q&A.
Well, thanks very much, Mike. In many ways, that's a sort of sobering look at the implications for investment of the pandemic. This is what our executive director has called sort of deeply troubling trends, deeply troubling news from the investment side. Lost jobs, economic opportunities today, possibility that the energy that's not being produced as a result of these cuts is something that we will need tomorrow once the economy recovers. And then, of course, this slowdown on the that we see in many clean energy technologies is the opposite of what we need in practice to meet our climate goals. So, as Mike was saying, that body of clean energy spend over the next 10 years would need to more than double to put us on track to meet those goals. One kind of more organizational point we've seen coming in on the questions, will we be supplied with a copy of the presentation deck? The slides that we showed are available. You can find them on the website. If you go to the homepage of the World Energy Investment 2020, in the left-hand menu, there's a button for downloads, and you can find the slides there. But with that, I think we would move straight on to the questions. Please keep them coming in, and we'll start with whatever selection Mr. Laszlo Varro is going to have for us. So over to you, Laszlo.
Thank you very much, Tim. My name is Laszlo Varro. I'm the Chief Economist of the International Energy Agency. And first of all, thank you very much for my colleagues for this fantastic work assessing the very complex picture of energy investment. We already have a set of very, very interesting questions, and I would encourage you to write further ones. But in the meantime, Tim, if I can start with asking that in the context of the energy transition discussion, we often emphasize the need to reallocate investment from fossil fuels to clean energy. Now, in 2020, in a very painful fashion, but such a reallocation is actually taking place because oil and gas investment declined by 30%, renewable investment declined only by 10%. So the share of renewables in investment in total investment is much higher than it used to be. And we have seen a series of big announcements from the major oil companies who are cutting oil and gas investment very sharply, but they make very high level, very strong strategic statements that they continue their investments in clean energy. So do you think that on the basis of the data that you found, is this investment reallocation is now completed? Can we say that the structure of the investment is now consistent with the energy transition? Maybe the level should be scaled up, or do we need a further reallocation?
Thank you very much, Laszlo. I will come to that just in a second, but I'm conscious of the fact that I've one other thing that I should be doing at the start of this discussion session is also to invite in colleagues who are on the line, Simon and Lucilla, who are key authors of the report. So if they wouldn't mind turning their videos and audios on, they can then join us. There's Lucilla, and I'm sure Simon will be with us in a minute. So the question is, are we closer to a structure of overall investment that kind of meets where we would need to be? I mean, it's true to a degree. I mean, if you just look at some high-level indicators, you know, that balance between the amount of money spent on fuels versus the amount that's spent in the power sector has shifted quite considerably this year. It would need to shift more in order to be consistent with what we model in the Sustainable Development Scenario. But I think there's still some other aspects of this that we need to bear in mind. I mean, within the power sector spending today that Mike talked about, over 80% of the money that we think is being spent on the power sector investment this year goes either into renewables or into infrastructure, so into grids. That's 80% today. That would need to shift some more. That would need to shift within 10 years up, well above 95% in practice. There are still some other needs in the system for flexible generation, but so that shift is not complete even in 2020. And then if you look at the fuel supply sector, then it's true that less investment in fossil fuels will be needed in a transition. That's undoubtedly true. But you still need molecules of some kind. You still need to be able to do all the things that electricity cannot deliver in the energy system, even as electricity becomes more important over time. So there is also a profound shift in the nature of that investment in liquids and gases towards a much cleaner production of existing fuels, and then a boom in the production also of low carbon fuels, whether that's hydrogen or whether that's biogas and biomethane, as well as technologies such as carbon capture, utilization and storage. And I think the other high level kind of indicator that is well off at the moment is really a geographical one, because there does need to also be a shift in spending towards the countries that are going to be the leading countries for energy demand growth in future. Many parts of the developing economies, we still have profound gaps in the supply of modern sustainable energy around the world. So you can't talk about today's allocation being adequate unless you also take into account those gaps in the system as well.
Thank you very much, Tim. Now, I would bring in Lucilla, who was our lead author on the electricity sector. Lucilla, there have been several questions from colleagues about the decline of renewable investment and the resiliency of renewable investment, especially in the context of developments in fossil fuel markets. Ever since the crisis started, we have been a bit overusing the term unprecedented. But what has been unfolding in European and Asian gas markets is genuinely unprecedented. Gas prices have declined to levels which were previously seen to be inconceivable. This dirt cheap gas is now feeding into power generation in electricity systems which have large excess capacity, leading to electricity prices which are rock bottom, and quite frequently major electricity markets actually go negative as well. So can wind and solar investment be really resilient in this context? Prices don't matter anymore. So what is your view on the resiliency of renewables?
Thank you, Laszlo, for the question. And before going to answering precisely your question, let me start by explaining a little why gas prices are particularly important to electricity prices. And this is because gas prices are often the marginal technology that sets the price in the wholesale market. And sometimes it competes with coal or hydro large reservoirs, depending on the country and the electricity mix, and not so much with nuclear or renewables, which are either must-run technologies or simply have lower marginal costs, which means that they are dispatched earlier and therefore don't set the price in that way. So in terms of how to lower gas prices and therefore lower electricity prices in the affect investment in renewables, this is, I would say that the response is there's an effect in the short term and an effect in the medium to long term. In the short term, what it means is that now renewable investments would have lower revenues coming from the market, and they are simply receiving a lower price. But in truth, what we see and what we've been told, also talking to many experts and developers, is that most of the renewable investments today are hedged in some form. For example, with underlying PPAs, long-term contracts for sometimes 20, 25 years, where the price is set. So the level of risk that these investments have in market price is lower. Sometimes there are other sort of mechanisms like subsidies or contract for differences or other type of government incentives. So in that sense, looking at how lower electricity prices affect the market, it's only a portion of the investments that are merchant investments that therefore have a lot of market risk. That said, there are other reasons why, apart from lower electricity prices, why we do see renewables, investment in renewables lower in 2020, and this is practical reasons because of disruptions in supply chain, mobility restrictions, which have sometimes reduced the ability to build and sometimes even access plants. Also, less activity in terms of distributed solar PV and small companies being more affected. In addition, starting from 2019, that was a very good year. So that's why we see the overall impact of renewables or investment in renewables already being affected, but not so much because of low electricity prices, because in that sense they are hedged. But so moving into the medium to long-term effect, the effect in truth will depend on whether we expect gas prices and demand and therefore electricity prices to remain low. If we expect that to happen, then we will also expect that the market and policymakers will adjust their expectations, and eventually this could translate into the level of support, or the level that then PPAs are signed would be lower, and in that sense we could see renewables being less immune. But this of course depends also on how the cost of renewables evolve in the coming years, and in the past years we've seen and we still expect cost reductions in terms of renewables. So in that sense, as long as the cost of the renewables lower at a higher rate than the price at which electricity lowers, the margins could still be good, and therefore the investment would be immune to this. Of course, this will depend on how the technology of renewables continue evolving, the technology of storage and cost of storage evolves, and to what extent we continue electrifying the world, and even, of course, policies and renewable targets. But that I would very much separate the effect between short-term and medium to long-term.
Excellent. Thank you very much, Lucilla. We'll go to Simon, who was the lead author of the section on the innovation and research and development. Simon, I had the chance personally to survive the previous financial crisis in the corporate sector, and I learned the hard way that it's very challenging to defend the research and development budget in a situation when the chief financial officer is counting pennies for the next quarter. Now, at the same time, I also read in the news that last week an experimental fusion reactor managed to attract private venture capital funding. So there are some conflicting signals. So if you could tell us, how do you see the innovation and research and development investment by the private sector, and to what extent this innovation investment is consistent with the technological progress that we need to achieve?
Okay, thanks, Laszlo. And it's a great way to frame this question, actually, to look at how do we expect things with some reflection on during the previous financial crisis. I think that's our key entry point into the insights here. And just to give people a bit more of an overview of what we've done in the work on energy innovation in this report, Mike presented the work on public R&D numbers, which many of our member countries helped contribute to. They supply us with the data there, and we've been able to put together the estimates up to 2019, as we do each year. And so we're looking at about 30 billion of investment from the public sector on energy technology R&D. But we also have methodologies for calculating investment in corporate energy R&D, and that was up to around 90 billion last year, another 3% increase similar to the public sector increase, and also venture capital as well. And we saw, a continuation of the boom in clean energy venture capital in 2019, with around 4 billion invested. So those are sort of the scales of the 3 areas of investment that we look at. But these are often statistics that come out once a year. Certainly the public and the corporate R&D spending is an annual exercise that we undertake. It's not possible to draw together the R&D spending project by project or precisely for the first quarter of 2020. But just like in all of the other areas of the report, we're very, very interested to know what's going to be the impact of the COVID-19 pandemic on energy innovation, in particular because the IEA is very persistent in stressing that these investments in the future of the energy sector, the way in which new technologies are going to penetrate the sector, will determine our ability to meet a sustainable development trajectory. And what that means in practice is we need a steady pipeline of new ideas entering into the innovation system, and we need the finances there to bring those through to market. So it's useful to look across the 3 different areas of financing and see how they might be responding. We do see different dynamics in terms of innovation investment compared to capital spending on energy assets. Certainly government public R&D budgets are probably locked in for a couple of years. They tend to be set on a multi-annual financial framework, but we suspect there could be pressures on those as we go out to 2021 to 2023. When we look at the corporate sector, there were already some areas for concern in terms of slowdown in the growth in corporate spending, particularly in the automotive and in the oil and gas sectors for kind of energy technologies more generally. I think, Laszlo, you clearly made the point that sometimes it's harder to defend these longer term, more uncertain returns investment areas when the corporate budgets are under pressure. But when we looked at the data for different sectors in 2009, 2010, we actually saw that across the board there was a significant slowdown in the growth in energy R&D spending, but we didn't necessarily see a decline, except for in the automotive sector, where globally we think energy R&D on new cars actually dropped about 10% in 2009, 2010. What we will see is we'll see less growth. We've already seen some survey responses that show that companies across the energy system are not going to be able to get the projects done that they were intending to do. And that's going to delay our ability to bring new technologies through to markets. In addition, the investment sector, the venture capital sector, has been underperforming in terms of the financing it's been releasing in the first quarter of 2020 because it's a harder environment to get deals done. And I think that the technologies that are slightly closer to market in the VC space will see greater uncertainty, and it will be harder for them to raise capital. They might have to sell themselves at below the previous market price. But having said that, we do see some technologies, you've mentioned fusion, but we could also mention hydrogen as well, where the companies are clearly expecting that governments are going to put in place or continue to put in place funding for major projects in the same timetables as before, whether that's in 1 to 2 years or whether that's in the sort of 5 to 10 year horizon. And so finance is finding its way to some of the technologies that are already gaining a little bit of momentum. What we have to do when we talk about the energy innovation system is put all of this together and draw some broad conclusions. And we think that there is a sufficient concern within the investment in R&D to bring this to government's attention and make sure that they both maintain budgets and spending in the public and private sector in the near term. We've seen some initiatives from the French government, the UK government, and now more recently the European Union, Germany, Portugal, to put money into early stage clean energy technologies or SMEs. But perhaps more importantly, to take the opportunity of accelerating investment for the longer term changes, because we're in a moment of transition in the energy system that could be ripe for disruption by new technologies as we go out into the 2025 horizon. And the IEA will be publishing at the beginning of July a special report on energy innovation with a major focus on what governments can do in terms of responding to the COVID-19 pandemic to keep us on track in terms of our clean energy technology development.
Thank you. We had several very interesting questions about the interactions between the financial impact of the crisis and clean energy investment. Some participants asked that with government budgets under a very serious pressure, there will be more need for the private sector to do the heavy lifting on clean energy investments. Whereas other colleagues in the webinar asked about the green stimulus programs and to what extent those green stimulus programs have a potential to significantly compensate the crisis effects. Michael, perhaps you would be best positioned for answering this. So how do we see the role of public finance versus private corporate investment in the clean energy space, and to what extent we see the green stimulus conversation leading to effective policy measures which can really lead to a higher than expected renewable investment?
Thank you, Laszlo. And these are also questions that are going to be taken up in a forthcoming IEA report, which is going to be released, I think, in about 2 weeks or a little less than 2 weeks on stimulus measures that's coming out. It's a World Energy Outlook special report. But just to talk about it in the context of some of the things we've looked at in the investment report. So just to be clear, first of all, our 2020 investment by and large reflects the world as we take it in terms of economic assumptions. So the economic assumptions are in line with the sort of lower for longer GDP assumptions of the IMF, so which envisions about a 6% decline in global GDP in 2020. And by and large, with most recovery packages or most stimulus packages not having been announced or the details not having been clarified, these investment data or these investment trajectory don't factor a near-term boost of those in. But of course, there's a potential over the medium term, over the next few years, for those packages to have a real effect. Now, when we're looking at kind of the public and the private sector carrying out investment, and this is drawing from some of the analysis we've done in the energy financing and funding section of the investment report. I've already talked about in the main presentation the role of state-owned enterprises, and indeed, state-owned enterprises are likely to play an important role in terms of carrying out recovery or stimuluses in some countries, most of all emerging economies, developing economies, where they still account for about 60% of energy investments. The challenges here, even with recovery packages, is that we have a number of SOEs and national oil companies who are indebted and poorly performing for several years now, and these have been hit quite hard by the crisis. One of the primary vectors in which they've been hit is companies that had high debt levels and high debt levels in dollar-denominated debts. So we see a number of countries ranging from South Africa, Brazil, Mexico, Russia, Indonesia, which their currencies in the first quarter of this year depreciated on the order of 15 to 25%. So immediately this had kind of a ballooning effect on those dollar-denominated debts. The risks that these raise for these SOEs is in their ability to carry out their investments, but also the fact that their financing position is tied to that of the sovereign entity. A number of sovereign governments have also seen increasing borrowing costs, increasing cost of capital, and so this in total undermines the ability of a number of these SOEs to carry out investments. Now, where SOEs function as a critical node in energy systems is not just investing in critical infrastructure and energy projects, but they also serve as the counterparties or the off-takers, particularly in the power system, and also other parts of the energy system, where they are the ones who are making the payments. They are the ones purchasing the electricity or purchasing the energy being produced by renewable projects, other clean energy projects, etc. We see this as a very interesting area to watch in terms of the ability of, for example, distribution companies in India to reliably make payments to renewable generators and to sign power purchase agreements. There has been some evidence from some countries, notably in India, where the central government is now trying to shore up the finances of these various entities and also institute payment moratoria and sort of buffers, offer liquidity buffers to enable these companies to better perform. But I think the case with the SOE sector will be very critical in terms of understanding how investments are able to carry forward and in line with a sustainable path. And maybe the last point I would add, because the question is quite big, when we're looking at the low interest rate environment, this also creates a very interesting opportunity for refinancings and acquisitions in the energy sector, where new types of investors, new types of private investors come in and play a role. We've already seen in the first quarter of this year, it's not data we have in the investment report, but just based on data we've seen from third-party sources, that even as capital expenditures are going down, the trajectory for M&A and refinancing is going up. So the low interest rate environment actually offers developers an opportunity to recycle their capital, to lower the cost of capital for new energy projects, which would hopefully then give them the confidence to invest. And for capital intensive technologies like renewables, but also things like efficiency and new technologies, this interaction between the energy and the financial side of the equation can be very critical in terms of improving the economics and the confidence of developers to invest.
Thank you very much, Michael. I would return to Lucilla. Lucilla, there were several questions from various participants about the electricity networks. And I agree with them that I also find it striking that electricity networks is actually the area where we documented the biggest investment decline. Now, practically every government in planet Earth likes to develop infrastructure. Smart grids are very popular among governments. And electricity networks are usually regulated by governments. There are regulated network tariffs, which provide a very stable cash flow for a network company, which is usually popular among investors. So in theory, governments like them. In theory, investors like them, and yet investment is not happening. So what is going on with electricity networks?
Thank you for the question. It is true that networks, because of their regulated nature, generally provide predictable and generally less volatile cash flows for investors. But the situation varies quite a bit between economies, so maybe I'll say something about that. In advanced economies, the statement you just made about the stability of the returns for networks is relatively unquestioned. For example, when we look at some of the major utilities in Europe, they have a considerable share of their revenues and EBITDA coming from networks. But it's not the case in most of the developing world, whereas Mike said, a lot of the investments are done by state-owned utilities, which are many times their financial ability is constrained, and we expect it to be much more. In fact, sometimes all of the investment in transmission and distribution are done by these utilities. And in many countries, especially in the case of transmission, sometimes private sector participation is not even allowed. So that is very much different to the case in advanced economies. And where there is private sector participation, or where there has been, the regulatory risk can be very high for investors. So the picture varies very much by region. And this is particularly important because when we look at, as you said, investments in networks have been going down. They had been going down. So in 2019, for example, they dropped 7% compared to 2018. And then in 2020, we expect another drop of 9%. But this was already falling short to what the investment needs to be 10 years from now. Because when we look at investment needs in our sustainable development scenario, for example, the investments in a decade from now are 60% higher in the sort of constant dollars than the 2019 levels, not even 2020. So that's comparing to 2019. And the gap is particularly big in developing countries and in China, for example. And in developing countries, this is what I was saying, how the picture is very different to advanced economies. A second point is that even when the returns are stable, they are sometimes less preferred by investors than other higher risk, higher return assets, either in the energy world, but also on the broader market. And third, and I think that this is an area that also us at the IEA may be looking at more, we may have a report coming out on this issue, is on the opportunities to invest in the sector and how they are different in nature to the generation space, which is one that there's been a lot of talk and the one that we generally talk about. And this is, for example, on the procurement side. A main way to attract private sector participation and capital to transmission and distribution is through long-term concessions. So it's a government tendering out a concession for an entire grid of a country, a state, or a relatively big concession area. And this is for maybe 40 to 50 years. Therefore, these are things that normally don't happen in a country or region. They are not as frequent as you can have various tenders for independent for power projects in a country. But these tenders take time. They take time to prepare. They require a lot of technical capacity. They take time to procure. They also require a high degree of regulatory capacity and enforcement while the transmission or distribution concessions are being operated by private investors. And a particular point is the price risk and the regulation around it. Because when we look at the case of generation and an independent power producer, generally the investor signs, the IPP signs a 20 to 30-year contract, and that doesn't have price regulation on price. The price is set by the bid at the beginning of the contract and generally maintained for the duration of the contract, sometimes indexed, but there's no additional risk in terms of price regulation. There may be revenue risk, but not precisely on whether the price that they will get paid changes. And that is quite different to what we see in long-term concessions for transmission or distribution, which require, and this is important and it makes sense, but they require being regulated periodically. The tariff that the investor would get is normally sometimes every 1 year, 2 years, 5 years, they get periodically regulated. And this requires a high administrative capacity on the government side to regulate the sector and to enforce the regulation, and also more confidence from investors on the regulators. And this is something that sometimes, for example, in developing countries hasn't always worked well, or sometimes there's not a lot of experiences. So in terms of looking at the future and how to attract more investment to networks, we need to have policies and regulation that send the correct signs to attract more capital. In advanced economies, this may mean continue having policies or strengthening policies and regulation and moving from only expansion or replacement to a higher promotion of resiliency and reliability of grids, so that grids can better integrate variable renewables or better integrate distributed renewables, and simply deal with frequency or reliability issues better. We have seen some of these, for example, in terms of digital grids. Now they take up a larger share of the overall investments in networks than they used to. In 2019, this was above 15% from the overall investments compared to less than 10% in 2014. And in the developing world, we also need to see regulation going more towards looking at resiliency and reliability, but also very much continue. There's a much higher need to continue expanding the grid because of electrification issues to connect people, especially in sub-Saharan Africa, for example. So regulation will be very much key, and the investor is one of untapped potential for investment without a doubt, but the regulation needs to be right.
Excellent. Thank you very much, Lucilla. I would turn to Tim. How do you see the investment challenges and the financial challenges of the major oil producers? Countries which spent half a century financing their governments from oil revenues, and where national oil companies play a critically important role in the national economy. And in the short term, they have to deal with the coronavirus crisis impacts, and in the long term, they have to deal with the energy transition. So how do they maintain investment, and what is their role?
Thank you, Laszlo. I mean, it's an extremely difficult question to answer, just because the depth of the cuts in fiscal revenue for some of the governments that we're talking about, for some of the countries that we're talking about, are extremely high. You take an example of Iraq. Revenue from hydrocarbons is probably going to come down by, I mean, if prices stay roughly where they are, at least 2/3 reduction this year. And you can already see that's having an extremely damaging effect on the Iraqi government's ability just to maintain current expenditures. So at the moment, the deficit, the monthly deficit, just to pay salaries and pensions and current expenditure for governments, is in the order of $3.5 billion. And it has implications also then into the money that's available for investment in energy. Because of the returns, it seems that a country like Iraq is going to prioritize the investment in oil, which means that there is less available then to capture the gas that's currently being flared that could be used in power generation, or to invest in renewables, or to invest in new infrastructure. We've seen some evidence that ambitions in all those areas are being pushed back. So it is a big dent also, for example, in Angola, the ambitions to restructure the upstream and bring in new players, that it's obviously more questionable in today's environment. In Nigeria, though, you know, there's the health of the banking system in some respects, I mean, could be subject to contagion from the effects of the falling price on asset values. So it does create an incredibly difficult environment for many of these hydrocarbon dependent economies. When we've looked at these issues, I mean, clearly there's a broader diversification challenge, which is not new, but of course it's made that much more urgent by what's happening today. And if you look at how countries may be building, and if you're looking for them to build better as they get out of the current crisis, you do have to look at the pricing arrangements, because by and large the fossil fuels are available at artificially low prices in many of these economies, and that distorts investment incentives across the board. And so we do think that now is a golden opportunity and a necessity, a fiscal necessity in many cases, to phase out those fossil fuel consumption subsidies, maintaining sort of targeted support for very vulnerable groups, but just to try and right those incentives across the economy, so that as investment picks up, it picks up in things that can lead to a slightly different configuration of assets across the economy as a whole. And I suppose that's true not just for fossil fuel consumption subsidies, it's true broadly speaking for pricing in externalities. You know, a period of low fuel prices should be conducive to those sorts of moves, to not just to get the pricing right from a sort of fossil fuel subsidy perspective, but also to introduce carbon pricing and so on. It has to be said that there is not a great deal of evidence that those batons are being picked up by governments around the world thus far. But we do think, and the IEA will certainly be arguing, that that's an important part of the solution.
Thank you, Tim. I would return to Simon. So we had a question on why we don't have a category in the investment report for renewables outside the power sector. We also had questions on hydrogen, on carbon capture and storage, on batteries, even on green ammonia. So Simon, could you tell us your insights and your view on low carbon investment other than wind and solar?
Okay, you've given me a nice long list there, Laszlo, to try and chew through, but I can at least sort of raise some flags for things that we actually do cover in the report and some of the messages that we've picked up on, because within the chapter, the section of the report that's on end use and efficiency investment, we do look at the investments in direct use of renewables in, for example, in buildings, in industry. So that's where you will find the renewables investments that are not for the power sector. And the things that we cover there in particular are solar thermal water heaters and biomass combustion boilers for buildings, for industry, for district heat. And one of the comparisons that we made in the report was between those investments in direct renewables, so it's really the end use to the conversion equipment. It's not the value chain for the biomass, for example, but in those equipment, the market values are sitting at around 25 billion per year globally, and that compares with around 150 billion per year for energy efficiency investments in buildings as a comparison. So most of the investment that's happening on what you might call clean energy in the building sector is going into energy efficiency measures, which means the investments in heating, ventilation and cooling, but also building envelopes that will consume less energy over their lifetimes and less into the direct renewables. But they are there, they are significant, and unfortunately we do see at a global level declines in investments, particularly in the solar sector. Hydrogen is something that is covered in our work on investment in R&D and innovation, and I think it's a really fascinating moment to be tracking the trends in hydrogen. It doesn't, it's not big enough yet to really show up in the global investment totals. We're talking about many millions rather than billions in this area, but the speed with which money is flowing into the sector is quite astonishing. We produced at the IEA a report called The Future of Hydrogen in 2019. In that year, we saw a big increase to something like 25 megawatts of hydrogen, water electrolyzers for hydrogen coming online, and we're very interested to see the rise of electrolyzers for industrial uses, putting hydrogen, or replacing hydrogen use in refineries and ammonia with clean hydrogen is one of the trends we noted. But we weren't really ready to see quite the increase in investment that could have happened for projects that are scheduled to come online in 2020 and 2021. And we've counted around 600 megawatts of projects that are in a very advanced stage of planning or actually in construction. And we would expect a significant number of those still to reach completion because they're supported by government programs. And so we think that we're ramping up still, despite the pandemic, a major increase in hydrogen, in clean hydrogen production, or at least production of hydrogen from electrolyzers. We don't see from commercial insights project delays at the moment, but we certainly would expect that some of those projects, rather than coming online by 2021, might come online in the subsequent years. But some really interesting dynamics. We're also seeing that being a major area for venture capital investment, and also something that features in a number of different published recovery programs. CCUS, obviously that has a link with hydrogen as well, because of the projects that are looking for investment to produce hydrogen with CO2 capture. But what we looked at in this year's report was the sharp increase in projects that are looking for funding under the 45Q tax credit in the United States. And we see now 15 projects that are competing for funding. And this is in a sense, this moment up until they need to enter construction in 2024 is critical if we're going to see a rebound in investment to the levels of interest that we had perhaps 10 years ago around the previous sort of publication and implementation of recovery measures, where quite a bit of money was focused on CCUS, in fact. But we have another word of caution around the CCUS projects, just because a number of those that are closest to completion have some interaction with the oil and gas industry, in particular for enhanced oil recovery, and the abilities for those companies to be able to take final investment decisions in or sign off-take contracts for CO2 might be challenged in the year ahead. But we're certainly hopeful that those projects do reach completion and come into operation within the next few years as planned.
Excellent. Thank you very much, Simon. We came to the end of our time period, so I would hand the floor back to my colleague Tim Wood.
Well, thank you very much, Laszlo, for your moderation of that. I mean, the questions we've received are excellent. We haven't been managed to get through all of them. I think in some cases we'll get back to people individually. I think we have contact details and so on. But just to say, there seems to be 3 baskets of unanswered questions, and they refer back to some things that mentioned already about upcoming reports. There's a sort of basket on innovation, and there Simon mentioned an Energy Technology Perspectives report beginning of July on the role of innovation in recovery and so on. There's a lot of questions also on economic stimulus packages, the extent to which energy and sustainability will be baked into those packages and the impact on jobs and so on. There I would very much highlight the forthcoming World Energy Outlook special report coming out on the 18th of June, which will look at those packages, the design of those packages in detail. And then there's a host of very interesting questions about, you know, the rebound in demand and the implications then for future market balances. And those really fall within the sort of work that we're now pivoting to on the new World Energy Outlook. So where we can't answer them immediately, we will be able to at least offer some views on that in the not too distant future. There was a few more practical questions as well. Just can we remind people where to get hold of the slides? If you go to the World Energy Investment 2020 page on the IEA website, left-hand menu, bottom button, there's a button called Downloads, a link for downloads, and there you can also find the slides that we used to launch this this report. And with that, I think it would remain only for me to thank you all very much for participating in this webinar. Many thanks to Mike for leading this work, to Simon, to Lucilla, to all the other colleagues who contributed in our investment team, to Laszlo Varro for his role today. And we look forward very much to having you with us in future IEA events. Many thanks.